Welcome, everyone, to another episode of the None of Our Businesses YouTube show and podcast. With me, as always, Mark Pallardy.
Hey.
Jack DiMatteo. Charlie Zigmund.
Thanks for joining us.
And AJ Wheeler.
What's going on, everybody?
And you know what we like to do. We like to get together once a week, look at the current events in news, accounting, taxes, business, and talk about all that from an accountant's perspective or mini accountant's perspective as it happens to be here. And so here's a rundown of some of the things that we're going to be talking about today. Big oil takes it on the chin. BP is reporting massive loss. Surprise, surprise. Identity theft scams involving unemployment benefits to watch out for. Markets have always been rigged and manipulated. Nothing new to see here. A new issue with the legal protections for social media coming out of the finance world. Are we dealing with another real estate bubble? Low internet speeds continue to plague the public here, even in North Hollywood. That's a DSL area. File your taxes to capture benefits related to the pandemic. And finally, Lockstep, a connected accounting app. It's in our neighborhood here in the Northwest, and it just got funding. All right. Well, let's get this started. Take it away, Jack.
All right, let's get right into things this week with an article that I think is going to be, this group's going to find very heartbreaking. Big oil taking it on the chin. One of the stalwarts of big oil, BP, announcing a record loss, $18 billion, 10,000 jobs being lost. But getting past that, it was a lot due to the shutdowns and that. But going through the article, I found some things that I thought were kind of interesting, where they were actually kind of admitting that, it wasn't just the one thing that I did find very surprising is what their range was for oil last year. They had it going from 55 to 75. And I know going into last year, there was really nothing that would indicate that oil was going to jump to 75. But as we got into COVID, that quickly changed. And at one point, I think it got down to about $20. So, BP felt the effects of it. But some of the things that I got out of the article were that they were going to start investing more in some renewable energy. They were admitting that it wasn't just the shutdowns that were starting to cut into some of their business. It was also the increase in alternative energy sources that were starting to hurt them. So if you guys could wipe your tears away and talk about the article, I'd like to hear what you have to say.
Well, makes me wonder if I were in. I haven't looked at their situation in detail, but if I were in their situation. Well, I shouldn't say if I personally were in their situation, but one of the things you might do in their situation, I should say, in managing the finances is look at kind of clearing off dead weight while you're going to have a loss anyway. Because I think people are expecting that there's a decrease in the consumption of gas and ultimately oil due to the pandemic. And so the fact that they're posting a loss isn't too surprising. And so then it's like, well, if we're going to post a loss anyway, why not clear the balance sheet? And so when you bring up the issues with the renewable energy stuff, kind of makes me think, are they kind of like taking care of a lot of things to position themselves better for the future in that regard?
Yeah, this is definitely the best time in history to post up all those losses because, everybody's got a free card to kind of put whatever they want at this point since everyone's expecting terrible financials. I thought it was interesting, and oil is one of those things that seems like, of course, it's going to go down during the pandemic, but then you would think that there would be some rebound from all the people trying to use delivery services instead of them going out to eat and that kind of a thing. And so while everything in the pandemic seems like it would go down, I felt like maybe oil would be the one thing that still stayed, relatively strong. It doesn't look like it.
You guys are very astute because as you go through there and you look at that article, they did throw everything, all the restructuring charges. They took this like, if it's going to be a bad year, let's make it a real bad year. Let's start with a clean slate. So you guys are very astute. That's exactly what they did. But, kind of when you think about it, everything that flies or everything that rolls on wheels is not moving this year. Or didn't move all that much last year. So, Mark, what do you got for us this week?
Yeah, I've got an article from the Journal of Accountancy, none too surprising. beware of identity theft scam involving unemployment benefits. So, of course, as we have seen the rise in unemployment benefits, naturally unemployment benefit scams are going to follow suit. And people who might have been working and might have had their identity stolen might be getting a 1099-G saying that they have to pay taxes on some unemployment benefits that they didn't actually get. And a funny anecdote, one of the reasons I'm bringing up this article is a friend of mine posted online that he received a check from an unemployment agency. He's fully gainfully employed. He tried to contact them and tell them, this is fraud, somebody's using my social, but they wouldn't talk to him because he didn't have the PIN from when he signed up for the unemployment. So he couldn't stop it. They sent him this check, and now he's just sitting on this check and he's going to have to figure out what to do with it. So, your government dollars at work. But I'm curious if you guys have any thoughts on this.
Well, a little bit of advice to your friend. On the back of the check is a line where you can endorse it, and then you stick that sucker right in the bank. No, I'm only kidding. But yeah, I don't think it's surprising. I think, being a kid of the internet, I guess, or seeing when the internet was born, it's no longer just a letter from a Nigerian prince that'll get you. It's every which way these guys can find to try and scam you. And it's more of I think it gets more and more like, hacking the person as opposed to just an email account or sending off a spam or something like that. And, we've heard of these, we've heard of course, the IRS scams. I think it's just, and not just for personal, or for just a person, it goes through businesses as well. So, I mean, it's like these guys, these scamsters or fishers are really astute at being able to manipulate what a form looks like and being able to. So, I mean, it really puts everybody on their most due diligence to make sure everything that's coming in is from a correct email address or an actual like employment agency or a government agency. It puts a lot more onus, I guess, on the person or the business to try and identify this stuff. And, it's not surprising to me that it's going on. It's just, I guess it's surprising that we don't have any better tools to prevent this stuff or some way to like hunt down the other side of the scam. At least when somebody showed up at your door and tried to scam you in the 80s, you had a description and a license plate number. Now it's just, some IP address from, Bangladesh or something that, got sent through 20 VPNs that you have no idea where it's from. So, I mean, it's just the age we live in, I guess.
Yeah, there was this show called like How to Catch an Internet Scammer or something like that. And they had the guy who did How to Catch a Predator, and he went to Africa as a result of some of these scam emails that he got, and basically went into a like internet cafe and traced them back to this area. And it was very anticlimactic because, like you said, when you even find the person, it's just some guy in an internet cafe in Africa, and they, nothing really became of it. And so that was really interesting and kind of sad because, yeah, there's just not a good method of recourse for these type of crimes these days.
This one's been making the rounds through, I'm in a BNI group, and the accountant in the BNI group's warned about this a couple weeks in a row, because what's going on here in Ohio is these employers are getting notification that somebody who never even worked for them is trying to get unemployment benefits. And, a lot of people would just look at that. Employers aren't versed in these things. They look at it and go, well, they never worked for me, and they would just throw it out. Well, guess what? If you don't contest that, they get those unemployment benefits. And all of a sudden your unemployment rate starts going through the roof because you're getting all these fraudulent claims. So, it's just, it's like AJ was talking about, it's the infamous $7,000 order where they try to call and get somebody to say, yeah, I ordered that. And, bang, they ship it. So it's just another, it just seems like unemployment benefits with all of what's been going on with COVID. It's just, there's so much being pushed through the system that people are trying to take advantage of that and fall through the cracks.
Yeah, I long for the days when you could tell it was a scam because there was incorrect grammar in the email. Everybody's a little too sophisticated nowadays. Charlie, what do you have for us?
All right, so I've got an article that I know we'll all agree with because it comes from a wealthofcommonsense.com. So, what can you say? But yeah, it says markets have always been rigged, broken, and manipulated. And so the stance of the author of the article is that actually, right now, it's, unfortunate that things are being manipulated in some way, but that's always been the case, and that markets are untethered from fundamentals and nothing more than a casino. And so he basically talks about how, for example, the discounted cash flow approach of valuing businesses wasn't even around until the 1930s. And he gives some examples of railway manipulation that took place back in the 1800s. And so it's his stance that, this is nothing new that we're seeing with this whole GameStop and shorting the market kind of a thing. And so, and he says also that if everyone were acting on perfect information, then why would anyone trade? They would just use the fundamentals that are printed as, and calculated on the stock quotes, and that would just be the best information. And so there would be no need for analysis or a stock market. You would just pick the one that has the best metrics. And so I want to get you guys' take on whether or not you agree with his stance. Do you think that markets have always been rigged, broken, and manipulated, or is this has it really grown in recent years?
Yeah, I think that's true. Markets are functioning on imperfect information, right? And so that creates the opportunity for information arbitrage in markets. And I think the last part of what you just said there is right on. Like, if you, in a hypothetical world that none of us have ever lived in, if you lived in a world where you had perfect information, then there would be nothing to arbitrage on a market, because the market would have incorporated all of that information into the pricing that is in the market. And so that's, that is kind of classic market economic theory. And I think that's exactly right. The question is how close to a perfect market are we? And what's the time horizon for that? And do you ever, and does it ever reconcile? Like, because the people who are more on the Benjamin Graham way of thinking in terms of, which is also the Warren Buffett way of thinking, right? Which is this idea that markets are not perfect in the short run, but you can do the analysis of what the value of a company should be, and you can look at that discrepancy in the short run. And if you invest for the long term, you can make use of that, right? That's the idea behind that. And so I'd be interested in kind of thinking about, well, is this author throwing that out the window as well? Are they basically saying markets are not only rigged in the short term, which is something I would totally agree with, and one of the reasons I don't spend time trading in markets like that. Does the author kind of take that to the next level and say, and it's that way in the long term, that it never reconciles itself? That would be unfortunate if that's the way markets actually were.
Yeah, actually, I think his conclusion is that markets still get things right over the long haul. And he kind of compares this to a casino, and people want to constantly compare stock markets to the casino where the house always wins. But the stock market has proven that that's not the case, that truly the real reason behind the stock market is for us to invest in corporations and help companies grow. And because of the growth of the American economy, if you can stick it out and try not to play all the games, you can be successful. I really enjoyed this article, Charlie. And one of the things I didn't know that I came away with, which brings me new light, is that in London, stockbrokers are called stock jobbers. So now I'm just going to think of all these brokers walking around New York as stock jobbers, and it's going to make it a much more amusing thing as I'm trying to make some money there. Other thoughts?
I think that's a great term, and it reminds me of another great UK term that I'd like to kind of introduce into our vernacular. And it's so if anybody in the UK finds somebody else who's like kind of semi in charge of a situation but doesn't have any real authority, and they just like to kind of boss people around with their clipboards or whatever, then they call that a job's worth, because apparently they have like just one job's worth of authority. And so I don't know that it relates to the article, but I just really wish we could all start using that. It'd be great.
One thing that the article reminded me of was the movie Casino. If anybody remembers the movie Casino, where the whale comes in and he's stealing towels and soap and gets off with $2 million of their money, and they have the plane go on the fritz and have him come back into the casino and gamble more. And the line in the movie was, "The longer they play, the more they lose. In the end, we get it all." Is essentially the Robert De Niro line. In fact, if you look at the market the way that he's talking about it, the longer you play, the more you win in that sense. So I guess it's the opposite kind of idea. If you have the right market information, if you're playing for the long term as opposed to the short term, I think, everything equal, it evens itself out at the end of the day, where you get more of that market condition. But I think in the short term, and especially what we talked about last week with the GME or the GameStop, I think especially the GameStop kind of situation really shines a light on overvaluation and how a lot of these things are a popularity contest now. And you look at these big runs on stocks or even, from both sides. I'm not talking about just the run from Reddit. I'm talking about the other side for the venture capitalists that took a run on the shorts. If you're too far on the fence or you're playing, you're playing with those stocks in the short term, there's going to be massive volatility and massive amounts of wins and losses there. And it's rigged. I think, it's correct to say that it's rigged because you have a lot of big money going in on one side. And the only counter to that was, of course, with the Reddit stock was the big money coming in from the other side to push the stock up. And you see the wild swing. You went from what we were talking about it last Friday. It was at like $380 or something like that. Today it's like $68. So you're talking within a week, it's gone down $300. I mean, that's crazy. It was $8 in December. So you're talking about $8 to $380 back down to $80 in the course of a month. So, and that's definitely sounds rigged to me, when the underlying fundamentals of the company are not. There's nothing that should be making that stock either that hot or that awful, I guess is my point.
I think, to me, I think the short answer is yes. I think there's, manipulation's gone out through the beginning of time, but I think kind of what the GameStop story is that, innovative people have the tools and the wherewithal to get in that game. More people have access to it. But I think the reason you don't hear as much of an outcry about this is, let's face it. So after the financial crisis and everything tanked, the stock market basically made a straight line up, tripled, in 12 years. So even with, the COVID disaster, and I don't know, if you guys were like me watching the futures in the morning and watching them lock out because they'd hit 5% down early in the morning, and just some of those horrific red days that we had, but now it's just a distant memory. We've gained all that back and then some. So I think the reason you don't hear more of an outcry or more complaining is that if you're riding along on that train, you're doing quite well for yourself.
I think that's exactly right. Do you have another article we can talk about, AJ?
For sure. Speaking of GameStop, this is a article that was in Bloomberg. Had to read it on Yahoo because Bloomberg wants my money. Yahoo doesn't. But anyway, the title of the article is GameStop Mania Stirs New Ire for Social Media Shield Trump Hates. Basically what they're saying and what the article kind of gets at is the fact that regulators now and U.S. Congress people are looking at whether or not they can hold, or whether or not they should hold social media platforms liable, or if social media companies have some kind of stake in the fact that essentially Reddit was the rallying place for all of these people to kind of step in and invest together against the GameStop shorts that the hedge funds had. And it caused, as we spoke about last week, chaos in the markets, chaos as far as hedge funds are concerned. And there was cries from the SEC or the NASDAQ, the CEO of NASDAQ for that we might need regulations in this. And it's no surprise that they're actually talking about this right now. Currently, the way the law works is that, Reddit or Twitter or any of these places just provide a platform for you to talk, and whatever happens on there happens between the people that are using it, and they're not liable for anything that's said or done as a result of that. And I think that essentially they're looking at what it would take, or in steps to hold possibly these people liable for these platforms reliable in some way to what happened with GameStop. And so I'd like to get your guys' take. This is kind of a weird and progressing story. There's a lot of technicalities in the article that we don't have to get into if we don't want to. But I'd like to get your guys' take on I guess, how we view this, or how, I guess, if somebody's starting like a social media platform or one of these, kind of SaaS companies where, you have a platform that's essentially a free speech area, or where people can post, if this is going to curtail, I guess, the barrier to entry even more, where you need a flood of legal teams that have even a better, terms of service before people start using it.
Yeah, I think Section 230 personally is a good law, simply because it takes the onus away from these companies to have to govern and watch over everything that their users post. I mean, if we did away with 230, which was the former administration wanted to do away with 230 so that he could go after Facebook and Twitter, et cetera, then all of a sudden those companies become responsible for all the content that their users create. And people are going to start cherry picking lawsuits and saying, well, I was defamed here or whatever. And I think if companies have terms of service and people break those terms of service, they certainly should be held accountable. But I don't know that these companies should be responsible for all the activity and should start policing it, because then you start getting into free speech issues. You start getting into, you're policing some, but you're not policing others. And the democratization of this whole thing by creating 230 seemed to say, well, let's give the platforms the benefit of the doubt, and let's not necessarily push them into policing every single one of their members. We saw it on the other side with Parler as well, and it becomes a dangerous precedent if you start saying that all of these social media companies are going to have to police all of their members.
Yeah, I'm with you, Mark. That seems difficult to administer. It seems like the only thing we can really do is have some kind of process in place that allows them to requires these companies to do something, but gives them recourse so that they don't, because the reality is, like you said, they can't police every single post. And so it seems like the best we can do is just have a process that lets these things get taken down and gives them the ability to, not sign up for unenforceable promises like we're going to monitor every single thing someone posts. But yeah, it seems like it has the potential to really infringe on free speech. But at the same time, I definitely don't want to live in a world where everyone can just post whatever they want freely. So yeah, it's a very, very difficult issue.
One thing I thought about when I was reading the article was, and this is from the hedge fund perspective, right? There was a lot of kind of examples of where a hedge fund manager went on to like CNBC or Fox News or something and was downplaying a stock and then took a short position on that stock, hoping that it went down after they presented that public information. Would then like Fox News or CNBC be held responsible for collusion in that same sense? Because essentially you're talking about the same thing. You're talking about a platform that somebody came on and essentially was, quote unquote, trying to rig the market the same way that essentially the same way that Reddit did. So I don't know. I think it's an interesting question, at least to ponder. But anyway, you got another article for us, Jack?
Yes, I do. I've got one that comes from USA Today, and it asks the question that always seems to be front and center in people's mind. Are we in another housing market bubble? And they hit all the right points. This is something that's kind of near and dear to me because I've flipped 30 houses over probably the space of the last 15 years. So I pay quite a bit of attention to the housing market. And from my perspective, it's frothy from the standpoint of there's not, you've got a better chance to find a unicorn than a good deal on a house to flip these days. But they hit all the major factors, and I think they're spot on about them. I mean, you've got very low interest rates. But I think the biggest driver to this, and it's been this way for quite some time, is the inventory is low. And I think with some of the postponements and foreclosures due to the COVID restrictions, that's been pushed back. And I think the Biden administration might have pushed that back now to September. I think it's gonna continue to keep these inventories artificially low. So as long as you've got, people looking for houses, and with these low interest rates and the financial wherewithal to do it, they're talking about how high these prices have gone up historically. It might be frothy from that standpoint, but as long as you've got, so many qualified buyers facing with the financial wherewithal to chase too little of an inventory, I think it can continue. And I think even it depends on what that glut of houses is when foreclosures start happening again, because a lot of those people will have had the time to get back on their feet. And if the clock starts running again, as though they just tack those months onto the end of the mortgage, you're not going to see a glut of inventory go on. So I think we could see a hot housing market for quite some time to come. What do you guys think?
As a former mortgage broker in a past life, I agree with you, Jack. I think there are aspects of this that could continue to drive up prices. But the other side that makes me think about, what about all of the investors out there who want to buy and hold rental property and rent it out? Because part of this article talks about how rents have started to drop significantly in a lot of major cities. And as a result, those people who are buying for investment purposes, they're seeing their cap rate go way down because they're not going to be able to make money off of these things if the rent isn't going to pay the mortgage, and if the prices just keep going up and up and up. They might be able to get a good mortgage and lock something in, but if their rent isn't going to cover what they're paying, they might think twice about buying that new piece of property. So I think there's mitigating factors that come into play here. And, as a homeowner, I would love to see prices continue to rise. But then at the same time, there are those who are renters who want to get into the home buying market, and it makes it tricky for them.
And somebody on the other side of the equation, I'm hoping that the prices come down because A, I'd like to buy another house, but B, also too, most of my mortgage is paid off and I just pay property taxes. So as my property value starts going up, I pay more in taxes every year. But, this is the smallest violin playing just for me, right? But I think you're right. And I think most of us live in the Pacific Northwest here outside of Jack, and the housing market here, you talk about record low inventories and I think I have probably half a dozen emails a week asking if I want to sell my house and how much it's worth. And I think, I think it's been kind of staved off by, like Jack said, with the eviction moratorium and the kind of rent moratorium that's going on. It is a rough time for real estate investors that are that are using their real estate investments for rentals. And good luck, like Jack said, good luck trying to find a property that's decently priced that you could renovate to flip. I mean, good luck finding one, because I think everybody wants to jump on those, like a starter home or a place that needs to be renovated. Unless it's completely underwater and owned by the bank, you're probably not finding it now. And if those places are available, there's probably 8 to 10 people in line in front of you that know what they're doing that probably want to buy that place for cash. So yeah, our friends in real estate or have real estate businesses, hold tight. It's probably going to be another rough year. And it's time to take a look at, but if you're looking to sell, I think this could be a perfect time. On the flip side, if you're in the market to sell your home and use it as like part of your retirement or something like this is probably a good time. On the flip side too, if you're looking to do a refinance and you're a business and own the property, or if you're a homeowner and own the property, now would probably be a good time to do it. Your price is going to be inflated. Your debt to equity is going to be higher. You probably get a pretty decent rate as well. So I think there's opportunity there, but you have to be in the right situation, I think.
It's funny, and any decent idea does not last 24 hours. We have a joke about it. There'll always be if something's been sitting out there even 7 days or more, there's a reason for it. It's a train wreck, or you'll go on the internet and they have one picture there for a reason, because it's a train wreck on the inside, and they're probably grossly overpriced. But anything that is a good idea, whether you're an investor or a home buyer, and you guys have probably heard all these same stories. The home buyers complain because they're looking, and before they can even bid on a house, it's gone, and it's gone for over ask. So it's It's a market I've never, in the time I've been following, I've never seen a market this hot. But Mark, what have you got another article for us this week?
Yeah, you bet. This is a little more on the lighter side, but I thought it was interesting and could point out some of the issues we've been talking about recently about broadband. From Ars Technica, there was a 90-year-old AT&T customer who's been a customer since 1960, who bought a Wall Street Journal ad to complain to the president of AT&T about his slow internet speeds. Apparently, this guy is paying like $50 a month, and he's getting 3 megabytes down in North Hollywood, California. We're not talking out in the rural sticks somewhere. He's in North Hollywood, California. And basically, I think the reason I wanted to bring this article to the table is because, yet again, we kind of have this monopolistic tendency of the cable and internet industry. And AT&T tells this guy, well, all we can get you in your area is DSL, which you're going to have the high-speed DSL. And one of the funny lines of this article was that I'm supposed to be getting 3 megabytes down, and I only get 1.5. And I don't care who you are, no matter what speed you say you're supposed to be getting, you can probably guarantee you're only getting half. So even at 3 megs, he can't even catch a break. But as we continue to kind of move forward and try to build out infrastructure, it just goes to show this is pervasive, and this guy has been a loyal customer since 1960 and still can't find any satisfaction.
Well, I don't want it to sound like I'm siding with the or the internet companies here, but if you look at the pure cost of like expanding the infrastructure for those things, I mean, one of the reasons why Verizon left our area for fiber optic internet is because they got in a real hole by installing fiber optic cable everywhere to be able to provide high-speed internet, and they ended up selling to a different telecom company. So these investments are expensive to be able to up your internet speed, and what are you going to do? Go with satellite internet better than nothing is what we called it on the podcast before. So realistically, the only way I see this coming around is if there's some kind of, I guess, government step in to help supplement these expansions of internet services, or if we've seen in the past cities provide internet access and lay their own line and essentially do it at cost is one way that sometimes they get around this. But you're not hearing of any hardwired internet provider startups. And the reason is because the barrier to entry there is just so high. I mean, you're talking about, you have to physically lay cable and have relays, or you're paying somebody to use their bandwidth essentially to wherever these, to the house that you're trying to service. So it's kind of a catch-22. I mean, you're talking about a monopolistic company that's like, well, you don't have any other choices. Sorry. And then on the same note, even if they wanted to improve the service, it costs an arm and a leg to do these infrastructure upgrades. So not that I feel sorry for telecom communication companies that rake it in because they have a monopolistic, basically territory, but there are some barriers here and there's some roadblocks to getting better service essentially.
I just wanted to share that nothing substantive on this other than the title of the article threw me, because the title says AT&T customer since 1960 buys Wall Street Journal print ad to complain of slow speeds, goes on to mention DSL. So I knew we were talking internet. I read that as AT&T customer since 1960 has been buying a Wall Street Journal ad to complain about slow speeds. And I was like, what the heck? How's that possible?
This guy's a time traveler.
All right, that's my contribution.
I'm just glad somebody's finally giving it to these big telecoms, though. It's great to see somebody finally speak up because,
complaining decades ahead of time. That's what you need to do to get any results around here.
I want to know how much this article costs. What kind of disposable income does this guy have to buy a full page ad?
$1,100.
I want to say if this guy's
There you
internet
go.
had been twice as fast, we wouldn't be talking about his message right now. And so I think there's kind of a silver lining here. We can get into that later. For now, I've got another article we can talk about from CNBC called "Everybody Should File Taxes This Year Due to COVID. It Could Get More Financial Aid." And so the article takes a look at some of the different economic stimulus payments that are happening in the U.S. and what people can do to make sure that they're getting those. It mentions that you should file your taxes even if you generally don't. If you're a non-filer, like a low-income person or somebody who just doesn't keep up with their taxes, that it may stop you from getting future economic stimulus payments because the IRS is using that data to split up to administer those payments. And so it just brought me to think, ultimately, what is more fun, getting stimulus money or not filing your taxes? What do you guys think? Which one's more fun?
Well, I think the article is definitely aimed at, I guess a lower income bracket, because I think it'd be prudent for some higher earners, especially if you switch jobs and got a better job last year, to not file your taxes or to wait till the last minute to see if this can pass. And then they go off of your prior AGI to determine your payments, especially if you're close, if you and your spouse or you're a single person and you're right at that $75,000 cutoff or 100, whatever the couples is, $150,000 cutoff, you'd probably be better suited to wait. So I guess it depends on your filing status and how much money you made, how much is showing up in your W-2s. So I guess it's something else for people to look at when they're deciding when to file their taxes this year. If you can hold out and they pass everything and they're going off a prior year, you might pocket more money if you're gonna exceed that threshold that they've kind of set out as what they want. But I think for those lower income folks or people that don't file taxes or hasn't filed taxes in some years, you should probably do it, because that might be the only way you get stimulus checks. Because we've talked about on the podcast before where people have not received their stimulus checks, the first round of stimulus checks from last year, just because they weren't on the books for the IRS for having filed taxes in the last couple of years. So I think anybody in that lower income bracket tax bracket, that hasn't filed in some years probably needs to, but I think you need to take a long, hard look at your AGI for the year and decide if last year was more advantageous than this year, or vice versa. If you lost your job, last year and you made a lot of money the year before, maybe hurry up and file the taxes so you're on the books for less AGI when they calculate the stimulus checks. So it's interesting. I think it puts the common person into thinking more about tax filings and what their AGI is and normal, if you're on either end of that spectrum.
Yeah, and I know, like with the first COVID relief, for people who didn't file taxes or didn't have a bank account, they were waiting a heck of a lot longer than those who had direct deposit with the IRS. Some people saw stimulus payments, within a week of it being announced, and those who didn't file taxes at all, some of them are still waiting for checks. I think. I agree with what AJ says as to looking at your AGI. I just think it's kind of funny because this article is clearly aimed at a lower income bracket. Even the title of it, everyone should file taxes this year due to COVID. Well, I didn't know at over a certain income level that I had a choice not to file taxes. I think, this is only aimed at people who might make that choice. And I am dubious that they're on the internet reading CNBC. But, if it's a feel-good article, then so be it.
Well, that's why we put out this podcast, to bring the word to those people who are definitely tuned into this podcast for sure. This is what I thought we were doing here. All right, AJ, do you have another article we can talk about?
I sure do. New week, new accounting platform that gets some money. So this comes from GeekWire. Love the name of the publication, by the way. Accounting software startup Lockstep raises $10 million to help businesses better manage cash flow. Now, when I first read the headline of the article, I was like, But essentially, this is a shout out to a Northwest company. So Lockstep, a Seattle startup using software in the cloud to improve accounting practices, has raised $10 million in Series A funding. And what I thought was interesting was that Lockstep sounds a little bit different than, kind of some of the accounting platforms that we've covered in the past that have gotten funding. Essentially, Lockstep is connected accounting, which relies on tools such as email automation and accounting-specific inboxes for AR and AP teams, helping to eliminate cash traps and cash leaks that occur through the human handling of company books. So essentially what this sounds like, and I don't know, I'm kind of optimistic and would like to look at it after reading the article, is that it's kind of essentially like a bill.com, I guess, for lack of a better word, for AR and AP systems that runs through a company's like email system, like an accounting at whatever your business is, or AR at whatever your business is.com. So essentially, they go through and kind of talk about how they're saving time and digital transformation and all that stuff, and taking the personal side out of doing AR and AP. But I thought it was kind of innovative and kind of nice to see an alternative, I guess, being funded to Bill.com, because currently, I mean, there are other platforms, but none quite as, I guess, sexy or well known as Bill.com. So I'd like to get your guys' take. Is this kind of a flash in the pan, or do you think this is something that we'll see more of, I guess, as time goes on? But I'd like your guys' take on this accounting startup.
Well, it's good to see some innovation in the space. I mean, because, everybody's just competing with the same people and basically providing the same level of service. And they're in there addressing some things where they see some cash leaks that they can fix. And it's interesting that you should say, Bill.com, because I just had a conversation with the client yesterday, which, Bill.com's the big player on the block, and most people flock there. But there was some basic functionality that they needed that I was really kind of shocked that Bill.com doesn't provide. So I think it's great to have innovation and competition in this space.
Out of morbid curiosity, Jack, what was the function they needed that they didn't offer?
Glad you asked that. So maybe somebody out here knows that they can. What they did is it lumped customer payments. So let's just say that you were paying four invoices to a customer. You would want to send that customer an advice remittance that listed out the 4 invoices that you were paying. From what they told me, it was lumped into one sum, and they couldn't provide that detailed remittance.
That sounds awful, honestly, because it's like such a key feature to just pay multiple bills that, yeah, I can imagine that. I will say the one thing I was really excited about with this integration that you mentioned, and the thing I think they really hit it on the head, is that by using email as the source, I think you get a lot better. I think everybody's on email, and so you get a lot better, adopting of the system if you have it run through that system, as opposed to trying to get people to have logins on your Bill.com or whatever, however sexy that might be. Email, I think, is always going to be a little more widely accepted. So I thought that was good. I'm excited. I think we can get as many of these as we can, because like we're saying, Bill.com doesn't work well enough to do it anyway. So let's bring somebody.
To be fair to Bill.com, it does run through email. So you forward to an email thing. And to be fair to Bill.com, you can send remittance, I guess, or PDFs of the bills you're paying with your payment. So, Bill.com does have some, not that I'm a shill for Bill.com, but I have sat on a few trainings, so I know the functionality of it. But I think competition is good, and I think the more players in the market and the more offerings there are drives the price down, drives the features up, and keeps, I guess, honest business practices. Nobody's, a monopolistic kind of entity that owns that space. I think it's good.
AJ Wheeler at Bill Shill. So my only comment on this article is that it seems, I mean, I know this is a startup, but it seems a bit premature to be writing a big article about somebody who has 180 customers. I guess at one point Tesla only had 180 customers, but this seems to be a lot of airtime we're giving to somebody who's relatively small. I think good ideas are good ideas, but and I'm all for innovation, but we'll see.
Well, and that goes along with the airtime we're giving 180 customers. Think about the money they raised on just 180 customers. That's the interesting part of these accounting finance forward tech companies that are raising money to scale when they're not at any particular scale.
So essentially what we're saying is accounting stocks are the next GameStop. We need to start, a Reddit post to boost these accounting stocks, and we all make a bunch of money because we get in at the ground level. Nobody's heard of Lockstep yet. I mean, we're going to be millionaires.
Yeah, but you can't talk about Lockstep because you're the bill shill. So that's the competition, AJ.
If it means $1 million, I'll cut my $20 check from Bill.com out. No, I'm just I'm only joking. Bill.com doesn't pay for this show or me. Is what the lawyers told me to say.
And if they did, we wouldn't be able to send the remittances anyway.
All right. Thanks for watching the show from all of us at None of Our Businesses podcast. Have a good weekend, and we'll see you here next week for more topics from an accountant's perspective in the news. Make sure you smash the like button, leave us a 5-star rating on Apple or where you get your podcast, and we'll see you next week.